The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains here for our once every 3 weeks Investors Observer members only workshop. Welcome to all of you. Thank you for coming. All right, so here's our agenda for today. We're going to look at some charts, talk about what else is happening in the market and the economy, talk about sort of what's hot right now. I didn't put it on the agenda, but I have a little bit about what I expect in 2022. And then we have some questions we got from people ahead of time. And we'll be taking, questions from attendees as well. If you have questions now, you can go ahead and put them in the box. If you think of questions while I'm talking, you can also just go ahead and put them in the question box. And I'll get to them either as we go or at the end. And yeah, you can send questions in ahead of time. A lot of people just reply to that invitation. Other people just say question for the workshop in the subject line. Just send an email in like you would any other question you had to our support staff, and those get to me, and I put them together here. So you get probably a little bit better answer if you do it that way. All right, moving on. All right, our first chart here is the S&P 500. We've gone sort of down and back since the last time we talked. We're, a few points away from the all-time high there. There's really not a lot of report to that. It kind of, bounced off the 100-day moving average as we've kind of seen in the past. But yeah, it's been sort of an interesting, volatile time with Omicron coming on, the holidays, things get a little weird around year end. So there's a lot going on there, but overall, I feel like that looks okay. The NASDAQ is a little bit more interesting. We'll talk about some components of the NASDAQ and some things like that on some subsequent slides, but it has further to go to get back to the all-time high and hasn't. Let's go back one. If we look at the S&P has hit that all-time high level a couple of times, whereas NASDAQ hit it about the same time initially and then hasn't made it back there, which is interesting, although maybe not altogether concerning. But it does have, sort of some more room to run before it bumps into that all-time high level, although it does look like there might be some resistance developing sort of in this level here. All right, the Russell is maybe the worst looking of these. Maybe it's the best looking, depending on how you want to think about it. Right, it actually broke out of this chart, I think, 2 workshops ago. So out of this range about 2 workshops ago. So that was probably about 6 weeks. And then fell back into this range it's been in basically for all of 2021. And it kind of bounced where it has found some support previously, and maybe we'll move back towards the top of that range again. That's kind of what I am expecting to happen, barring some unforeseen event. All right. Comparing the S&P 500 and the equal weight version. You can see after outperforming for most of the year, the equal weight, which is the red and green line, has snapped back to and has pretty much been roughly equivalent to the cap weighted version. What that means is, to sort of close this gap, because this is the percent change from the start of the year, the bigger, the 5 big tech stocks at the top of the S&P 500 had to kind of catch up a little bit in terms of the performance there. And that's kind of a thing we've seen here in the last few weeks. All right, growth versus value, a similar story. Here we have growth in the red and green line, value outperformed for much of the year. And then growth rose to the top, and the gap has sort of closed again more recently. this is kind of interesting. We got some more stuff coming up here. So yeah, Jets versus Apple. So Jets is an ETF that just tracks the airline stocks. I like to use it sort of, or I have been using it during the pandemic as a little bit of a proxy for reopening, and sort of what that trade looks like. Obviously, earlier in the year, people were excited about vaccinations and things reopening. Jets was up. Apple, sort of big tech, a stock that, you know, did extremely well for all of 2020. Didn't do so hot to start the year. More recently, we've had variants and other things happen. Apple has been strong. Jets has been less strong, although starting to pick back up again here. I share this really because it's interesting that, right, Apple is not really anybody's idea of a stay-at-home stock necessarily, right? It's not a Zoom or a Peloton or one of those things people were buying early in the pandemic. But big tech is in today's market, sort of a, if not flight to safety, at least flight to quality kind of trade. So when people get nervous, they tend to buy things like Apple, and things like airlines don't do as well. So the fact that these things did kind of the opposite throughout the year, one was up and the other was down, struck me as interesting. All right, so this one I share because the charts are very similar. DDOG is Datadog. You may or may not be familiar with it. It's one of any number of relatively recent IPOs. I forget if it came out in 2020 or 2019. But it's been around a little while. It's an unprofitable sort of cloud tech company. And I really just wanted to share it because the chart looks a lot like the chart of Tesla, which is the blue line here. Tesla obviously had a few more highs, but more recently, right, they've both been sort of in a very similar pattern here in terms of being up or down on almost the same day. And really, I think this is an interesting story that we've started to see develop here. Is a lot of the, not the sort of classic meme stocks and sort of your GameStop and your AMC, although those have really been smacked around the last few weeks, but a lot of the other sort of stuff that had a lot of hype around it in terms of unprofitable technology stocks, Tesla, stuff like that has really sold off pretty hard. To go from being up 85% on the year to up 60% on the year, right? Everybody will take a 60% return on the year, but it's also a 20% drop in the last couple of weeks for some of these things. That's pretty significant. All right, and the other thing I wanted to share, and this is a little bit harder to see, but you can see it in a few cases here, like right here where we have, so this is the NASDAQ is red and green here, and then Bitcoin is in the blue. So we had this big day on the NASDAQ here, and Bitcoin was down the same time, here, down, down. But they kind of went up together. This is only 90 days in this case. So I had to chop it down a little bit to get it to show up correctly. But the reason I include this is Bitcoin has started to trade sort of alongside a lot of what people tend to call risk assets. So, right, like when the market has a bad day and people go to cash or, treasuries, something like that. There were times during the pandemic, particularly sort of early on, where cryptocurrencies and some other things, especially, Bitcoin, would rally. That seems to be less the case now, in the sense that it seems to trade along with the NASDAQ, but also this sort of pattern here puts it in a class of things that is much closer to these stocks we were just talking about here, Datadog and and Tesla in terms of just losing a lot of value over the last couple of weeks. But I do think it's interesting that when the stock market has a big down day the last couple of times, the cryptocurrency complex has also had a big down day. That's a kind of recent development and suggests that people are viewing Bitcoin less as a, or at least some people are viewing Bitcoin less as a safe asset and more as a risky or more speculative asset. All right, what else is going on? Last time I said it was too early to really talk about Omicron. This time around, it kind of seems less bad than feared in terms of being very spreadable and contagious, but overall sort of less dangerous. So what I think that means is you might have in any given workplace, more sick days kind of all at once, but fewer hospitalizations and deaths that result from that. Whole bunch of people getting sick isn't great, but it seems better than some other potential things that could happen there. If it can overtake and provide immunity against sort of some more dangerous variants and infections, it could move us closer to whatever the new normal looks like. That is very much still unknown, and either way, I don't think getting sick is anybody's idea of a good time. But it is interesting. It's sort of the first variant that has been less severe in terms of the potential outcomes for any given person who gets sick. Obviously, a ton of people are getting sick right now, but it seems to be less severe, which is kind of positive. The Federal Reserve and inflation are sort of the big drivers of stocks right now. I think we're looking at sort of a place where for a long time after, really sort of since the financial crisis, but especially when we were getting into the sort of interest rate normalization part of that recovery where we had some tapering and then a short interest rate rising cycle there. The jobs numbers were the sort of the biggest thing and would really move stocks around. Because so long as the labor picture held up, it seemed like the Fed was willing to tighten a little bit. In this cycle, I think the inflation is going to be much more of a driver of Fed policy, just because it's been hot, right? Like the mystery after the financial crisis was sort of, where is inflation? Unemployment kept falling and falling and falling past what people thought was full employment, and we didn't really get any uptick in inflation until a little bit in 2018. But the Fed was basically raising interest rates, tightening and raising interest rates by watching the labor market. Whereas this time around, I think they're going to be much more attuned to the inflation side of that picture, right? The Fed has a dual mandate in terms of maximum employment and price stability. And so I think they're going to try to walk a very fine line between letting the economy run hot and letting the economy run too hot. And so this puts the risks at more, whereas previously when we were watching the employment picture, the risk was the Fed will tighten too fast and kill the jobs recovery. In this case, I think the risk is really inflation gets too high, as opposed to, right, we raise things too fast and the economy slows down too much. I think in this case, they're trying to be very, very gentle on that side. So I think the risk is really to the high inflation side, which makes the CPI numbers and other measures of inflation probably have more influence on stocks really as things come around. But the other things are, right, like there's no interest rates that unload boats faster or moves trucks faster or does any of this sort of fixes any of the sort of supply chain and some of the other problems that we're seeing across the economy. Those things get fixed through things like capital investment by businesses that increase capacity in various parts of the supply chain, production of goods, whatever that looks like. Another thing, I mean, quite frankly, another thing that would help with some of the goods inflation is some reopening and people transitioning spending back towards more services. And we'll see how that goes as 2022 progresses. Currently, there's no real indication that consumers are panic buying, right? One of the things you worry about in an inflationary spiral is people think, okay, prices are just going to go up all the time forever. So right now is the cheapest price I'll ever get for whatever. And so they just buy it now at whatever the price is because they are convinced that the price in the future will for certainly be higher. We're not really seeing that right now. Right, like that would be a signal that people expect inflation to remain high. The fact that we're not seeing that, people seem to be sort of delaying some purchases because of inflation, means that they expect inflation to normalize. And yeah, it turns out that if people are panic buying, right, if you just clear off the shelf every day at the store because today is the cheapest it's ever going to be, and the next time you have to buy it, it's going to be more, right? Well, that just leads to a spiral of higher and higher and higher prices because you just wipe out the inventory every time, and so demand outstrips supply just sort of forever. The fact that we're seeing the demand side ease back as prices rise suggests that people are being pretty rational and aren't expecting a real inflationary cycle there. All right, so stuff that's hot right now in terms of short term, the last month or so of trading. Energy is back at the top, although it's interesting, gas prices have fallen. Some number of states are have an average price back below $3. So gas prices have fallen off a little bit, but thermal coal still high. That's partially a function of some energy shortages and some other sort of global economy things. And then exploration and production and the oil and gas integrated are what's high. Midstream had been among the leaders in the energy sector, and that has dropped out of the top three. Real estate, I believe real estate was at the top the last time we talked. I forget what this looked like before I redid the slide this time. But yeah, it's residential REITs, industrial REITs, diversified REITs. Yeah. The housing market remains hot. That includes the market for rental properties. Industrial is a lot of warehousing and other sort of things that have logistical applications. It's not hard to understand why in a time when there's everybody's talking about supply chains that things like that would be in demand. And then diversified REITs is just like things that have a group of stuff. So it may have residential and industrial in its portfolio. It may also have some commercial or other things. Yeah, so in financial services, I was at the top not too long ago, but it's slid to third. Financial conglomerates, regional banks, diversified banks. Those are interesting in the sense that they're pretty boring, right? It's not investment banking. It's not asset management, right? Those are sort of financing the real economy kind of things, which is what you would hope for in a in the period we're at in the economy right now, where it seems like we're hopefully coming out of this long pandemic thing, and the economy can try to recover and get back to normal. Utilities is interesting to see come to the top. Gas, water, electric. I don't put too much stock in the fact that it's gas, water, and electric in that order. I do think that some of this is related to interest rates. Interest rates are still very low, even though people are talking about raising them. So utilities are a relatively stable way to get a steady return because most of those companies pay a pretty solid dividend. Also with some volatility like we've had the last week or two, utilities are a good place to go there because gas, water, and electric are bills that consumers will keep paying even if they maybe stop paying some other things. Although it is interesting to see that consumer cyclical, which seems to always be in the 5th spot on this list, regardless of what sectors are above it. What's doing well in the consumer cyclical sector is residential construction, which is mostly home builders, luxury goods, and then leisure, which is a very different picture from what are the things where people stop, right? What are the bills people will keep paying? Right, like luxury goods and leisure are things you'd think would go out the window. But I think this paints a picture of one, a stock market where people aren't sure and looking for safety is the utilities piece. But then generally the economy is pretty good, right? People have money, unemployment is falling, wages are rising. The home builders have been doing extremely well. They're selling every house they can build for pretty much whatever price they want to charge, which is a nice spot to be in if you're running a business. And then, yeah, luxury goods, travel is starting to open back up again. That stuff kind of makes sense to me in terms of why that would be here as well. All right, so what's next? So I actually included a user question here because what's next is, before we get to 2022, is the end of 2021. So on the Santa Claus rally, a lot of people sort of incorrectly talk about the Santa Claus rally as like stocks being up in the month of December or something like that, but it is sort of according to Hoyle, technical definition of the Santa Claus rally is from the first trading day after Christmas to the first, including the first 2 trading days of January. So that period there. So this year it'll be the 27th through like the 4th. Yeah, through the 4th of January. So the interesting thing is nobody really has a definitive answer for why it happens, but it does happen sort of more often than not. I think one of the reasons, and the reason that makes sort of the most sense to me for that particular period, is there are just fewer active traders and sort of more passive investors. So if you think about the stock market and investing as sort of what money is flowing in and what money is flowing out, right? I have a bunch of recurring deposits that are set up in terms of like, some saving vehicles, some retirement accounts, things like that, right? Money just goes to those. It gets allocated the way I have it set up to be allocated. That it just does it, right? I don't even have to think about it. It gets taken out of checks. It goes. Lots of people have that, right? For things to be sold, that means somebody has to make a decision and put in sell orders. So that week after Christmas and the first 2 weeks or the first 2 days of January, lots of people just aren't paying attention to the stock market in those times. So what that leads to is you still have some of that passive money flowing in, and you have fewer of the people who are making decisions about selling. I know there's tax loss harvesting and a bunch of other things that happen at the end of the year, but I don't think that necessarily happens. Yeah, you can do that anytime you want in December. You don't have to do it in the week between Christmas and New Year's. I think most people would kind of prefer not to work in the week between Christmas and New Year's. And so I think that's really why a lot of that happens. Again, nobody's ever really been able to prove why it happens, but it does happen pretty significantly more often than not. All right, so after New Year's, we are into 2022. And what I expect in 2022 is sort of a continuation of recent trends. I think less of the sort of volatility we've seen really since around the time the Omicron variant was discovered. I think a little bit less of that, but more of the reopening and real economy stuff being strong. Supply chains, I think, are going to remain a concern, but hopefully some of that will ease a little bit, especially if we get some reopening and some more consumer spending goes to services. unprofitable speculative technology stuff like we were looking at with the, so kind of my point with that Datadog Tesla slide was that a lot of that stuff has been strong for some of it 2 years, and a lot of it has lost a ton of value more recently as people seem to be rediscovering the rest of the economy, right? Like General Motors stock has done better the last couple of weeks. Some stuff like that, right? Some real economy stuff that maybe was overlooked, right? The value stocks, have been a little bit stronger, particularly in some places like home builders or something like that. So I think the unprofitable speculative tech likely remains volatile. I think some of that's going to continue to lose value. Some of it might level off. Tesla is a weird case just because it's a company that has a founder that has a lot of fans, and he seems to be able to move the stock price around by tweeting, which is not a thing most companies have the ability to do. But generally all of the sort of EV, we have a question coming up about that. The electric vehicle, right? Like difficult to explain and unprofitable cloud technology providers. I think a lot of those stocks just got to be super high priced, and they're all kind of falling. A lot of the stuff that went public via SPAC in the last 2 years has also, I would put in that bucket. Crypto sort of remains the Wild West. I expect it to get increasing amounts of media attention. Right, two of the big exchanges in terms of FTX and Crypto.com are, they're going to be airing Super Bowl ads. Maybe someone will discover a practical application for it that it breaks through to people that want to actually use it for something as opposed to just trading it. We'll see. I expect we'll be talking about it more as we go through 2022, just because it's going to be a thing that's in the financial press a lot and probably attracting more and more assets. I genuinely expect the virus to sort of start to take a back seat. We'll see. Hopefully there doesn't become a new variant that has that people start to get concerned about again. But I think, I don't think it ever really goes away at this point. I think what happens is risks start to approach that of car travel, where right? Something like 40,000 people in this country die every year due to automobile accidents, but you never really think about that before you get in the car. Whereas right now, I think a lot of people are thinking about like, okay, what do I do about coronavirus before they go somewhere? So I think it gets to something like car travel where people take some precautions. They're aware that there are risks involved. But it stops being a thing that becomes quite so influential over people's decision making, which is, that's what an economy is, right? It's just a bunch of people collectively making decisions. And I think towards the end of the year, especially, inflation starts to level off, maybe starts to fall. Especially if virus starts to take a back seat, you get people going out more. A lot of the shortages and price things have to do with people spending more money on goods than services. And so it just jammed up all the ports of people buying stuff instead of, getting haircuts, going to restaurants, things like that. So if some of that spending shifts back, it, just lessens demand for some of that stuff. So that starts to look a little bit better there as well. All right, questions. So Charles asks, do I believe electric vehicle and crypto are bubbles that could negatively impact the market beyond those sectors? Look at the Tesla math, the number of options, YOLO and weekly, to on crypto. Well, so the EVs have been beaten up, and frankly, some of those pure play electric car companies still look pretty high to me. Tesla fell close to 30% from high to where it was earlier today, and still has a price to earnings ratio above 300. Tesla is profitable, but barely, mostly due to the fact that they can sell some carbon credits. Pretty much all the rest of the pure play EV companies, you're Rivian, Nikola, Workhorse, Lucid, and the Chinese ones too. NIO is the big one there, I think. Aren't profitable. Tesla at least ships a lot of cars, at least a lot of cars compared to the other electric car makers. Not a lot of cars compared to GM or Toyota, but they do ship a decent number of cars. Nothing is impossible, but everybody who makes cars right now is an electric car company. Right? Like GM is doing a whole rebrand. Ford is pretty much the only advertisements you see on TV for Ford are for, right, the electric F-150. Right, every car company is an electric car company now. So those real small companies that don't make any cars or make almost no cars, they're certainly not producing cars at scale. Yeah, they now have to compete against all the gorillas in that industry, and it's going to be tough, and a lot of them aren't going to make it. Can I tell you which ones? No. Right, like everybody seems to have their own strategy and is trying to pick a lane, which I think is smart. Right, like if you're going to make a new car company and come out with six cars to try to fit every market niche, you absolutely would just get wrecked there because there's no way you can make that work. But I think generally there are probably going to be more losers than winners in this group. But yeah, I can't pick which ones are which. Crypto, yeah, the big ones are also well off their highs, right? Like Bitcoin has been, I forget what the high is at this point, but it's been pretty high and it's closer to 40,000 now. And like I mentioned earlier, the big cryptos, your Bitcoin and Ethereum, are starting to trade more like risk assets. There are some other projects that are still rising and setting new highs. But ultimately, crypto is an incredibly new, very immature in terms of the technology and poorly regulated space. My team and I did a lot of research in terms of obviously the sort of research anyone does before they launch a new product in terms of market research and things like that, but also in terms of studying the space and what's going on and what can we offer to people in terms of analysis. And the reason the Investors Observer cryptocurrency product focuses so much on technicals is because that's really all there is. Technical analysis works across asset classes, so it's a thing that we can believe in and feel like we can provide some value. But fundamental analysis in that space is possible, right? Like these aren't companies; they don't earn any money. And to be frank, yeah, it's impossible to tell on some level which of the which of the smaller cryptocurrency projects are scams and which aren't. We tried to put in, we built the risk reward score to try to weed out just from a money flow perspective things that are potentially scams. But our data provider tries to find the scammiest things and either not list them or takes them down. At some point, if that happens, if they something starts to look fishy there. But yeah, it's the Wild West. There hasn't really been any development in cryptocurrency where I've said, okay, this is the thing that I want, right? Like this is the thing that I want. Like I'll admit to being skeptical about smartphones at first, but at a certain point, the technology got good enough where I was like, hey, that's the thing I'd really like to have. And so I got one. Cryptocurrency isn't there yet. There is not a thing that you can do with cryptocurrency that is easier, cheaper, or faster than things I can do with, regular money that has made me want to get involved in that space at all. So yeah, back to the actual point of the question. Bubbles that could negatively impact the market beyond those sectors. Tesla's in the S&P 500 and one of the bigger companies. So, a giant drop in Tesla would probably have some impact on other stocks just because an S&P 500 fund would lose some value and there'd probably get some forced selling there. But generally, most of those companies are, they're highly levered, but the amount of debt is not so much or so concentrated that would cause a problem. And crypto, where I think you worry about things in crypto is the big stable coins, which function a little bit like money market funds. I think it's possible a run there could cause some problems. But I think they're the kind of problems the Federal Reserve would, quite frankly, be able to step in and kind of mop up in terms of some weird repurchase or liquidity operation that just kind of, serves as a sort of backstop against some of the ugliest effects of that. But yeah, I think right now most of those things are concentrated enough, or not concentrated enough, isolated enough from sort of the regular economy that I don't think it's a huge deal. And yeah, I mean, right, Tesla's lost 30% of its value in the last couple of weeks, and the S&P is still in spitting distance of a new all-time high. So just to sort of test that theory, I think maybe that kind of bears that out. All right, so Jeff said gold is supposed to be a hedge against inflation and a bear market, but with all the uncertainty right now, why aren't gold stocks doing better? So one thing is that the term hedge against inflation means a very specific thing, and it doesn't mean outperform the stock market. So let's imagine a scenario where inflation is 10% a year, okay? So $100 in a year will be worth $100, okay? Because we're using dollars to measure the worth of things. A perfectly hedged against inflation something would be worth $110, right? Because you've taken your $100, you've accounted for inflation. Inflation was 10%. Now you've got 110. Cool. $100 invested in a company that grew by 25% would be worth $125. And 25% growth isn't out of the question. So, right, like if you just look at it from this perspective in terms of which of those three things do you choose, I feel like you choose option 3 every time, right? So there's that. The other thing is gold trades in a market just like anything else, right? The past 12 months performance for gold is down about 3.5%. Dollars over that term, priced in dollars, are flat, right? Like $1 on January 1st of 2021 is worth $1 today. And the reasons for that are gold is not some pure inflation hedge, right? Like it doesn't exist in a bucket until somebody gets worried about inflation and then people buy it and the price goes up, right? The idea of gold is the value stays the same and the price of the dollar will change around it. So there could be lots of reasons for gold not performing well, right? One is people choosing other inflation hedges. A lot of people that used to spend a lot of time talking about gold are now, sort of, libertarians and other people like that are now very into Bitcoin and things like that. So it's possible they're viewing it that way. The tips market is not huge, but it's not tiny either. I think a lot of asset managers, it's probably just easier for them to buy Treasury inflation protected securities, which, give you whatever the interest rate is plus the CPI, basically. So even if inflation is higher than your, the yield on the the sort of classic Treasury tips, you get compensated for the inflation there as well. Right, and then there are other reasons that people buy gold that aren't inflation. right? Jewelry, some of it's used in electronics, stuff like that. So a big drop in demand from some other gold buyers could leave the price lower, even if people are actively buying gold to try to hedge against inflation. And the other thing to remember is gold is just like any other asset. The value of gold, whether whether you have coins or bars that you physically have at your house, or you have an ETF that owns gold or bars, or well, a gold mining company gets to be slightly more complicated, but it's a proxy for the price of gold in any case. The value of all those things is exactly what someone will pay for it. Gold is one of several relatively rare shiny metals found on this planet where we live. It doesn't have any magical price floor or intrinsic value other than the value that someone will pay for it. And so yeah, I've never really been a particular big believer in gold as a hedge against inflation. I feel like in a true apocalyptic end of the world scenario, I'm not sure what value gold does there. Gold has always seemed like a thing that would be a perfect hedge in a case where everything in the world is the same except the value of the dollar changed drastically. And I have a hard time imagining exactly what it is that brings out that exact situation. So, yeah. I think supposed to be a hedge and is actually a hedge are different. All right, so Eugene had an options question. Can minimizing of risk on an option trade where time decays in favor of the trader be achieved by extending the expiration date of the option position? For example, what about creating a bull put spread with leaps on Apple when Apple is at major support? So yeah, basically I think what this trade boils down to is, are longer trades safer than shorter ones? And anytime somebody asks me about, is this safer than that? I always have a bunch of follow-up questions, because there's a lot of different ways to determine risk. And yeah, safety and risk are functionally the same thing here, right? So you have things like the probability that your options will be assigned, right? If you're an option seller, you, in most cases, especially bull put spreads, don't want your options to be assigned. So that's one way to look at it. Risk reward ratio is another way to look at it, right? People try to, a lot of spread traders try to set up a trade so, maybe you can't lose more than twice your potential profits. Some people go even higher than that. Some people go a lot lower than that. It really depends on how you're sort of measuring risk. And so all of that is sort of preface to say that for time decay strategies like bull put spreads, I think shorter is better. And one of the reasons for that is time decay is fastest closer to expiration. So if you put on a year-long bull put spread, you're not actually making any money in terms of, right, that time decay isn't actually happening until you get relatively close to expiration. So basically what you have is a sort of relatively illiquid, right, you have a thing that's relatively illiquid, and also now it has a long date in time, so it's not really going anywhere. So you've kind of just tied up your money. It will become more liquid as the time decay starts to happen more. But that seems to me like an argument to just trade in shorter dated, more liquid options. And the other thing is that option prices for a given expiration date are priced to reflect the potential stock movements over that time. Right, so a 1 week option versus a 2 week option, right? The 2 week option reflects all the potentials from 10 days worth of trading, whereas the 1 week option reflects all the potential from 5 days worth of trading. So a trade that returns some percentage return in January 2022 will be a lot closer to the money than a trade that returns that same percentage in January 2023. So there's not really a ton of difference in terms of the safety from that. standpoint. And yeah, so for a very long dated trade, you have more chances for the stock to make a bigger move. Obviously, a stock will move longer in, can make a bigger move in a year than it would in a month. So to find a trade that has roughly the same return, you're looking at a much lower annualized return, right? You're going to get about the same actual return, but now instead of doing it at a week or a month or a couple of months, you're doing it at a year. So your annualized return is just much, much lower. And the reason for that is the delta curve, the way delta curves, which is measured by gamma, is less steep for longer dated trades. And so what that means basically is that the prices of your options move much less for a movement in the stock. So even if time decay isn't really happening, right? Like if you have a relatively slow time decay, you might say, well, the stock will just move away from my trade and I'll make my money that way. But that doesn't really happen with long dated options either. So yeah, generally, I don't think a long-term trade where you're selling premium makes a lot of sense. I think, yeah, I don't know that it's necessarily more risky. It just seems to make less sense to me because the returns are lower. Now, longer can mean safer for strategies where you need the stock to move. A thing that I think people frequently forget is you can sell options, right? You don't have to hold them until expiration and hope you get, to exercise them. More time means more chances for the stock to move with less time decay. And so a thing that I think people should frequently think about is if you think the stock will make a move in the next 2 weeks, yeah, you could buy something that expires on the Friday 2 weeks from now. But what if you're off by a week and the big move happens in 3 weeks? Well, now you lost it all, right? What you might want to do is buy an option that expires in 6 weeks or 3 months. It'll still move. It won't move as dramatically, right? The price won't move as dramatically with the change in price of the stock, but you also won't be getting killed every day from time decay while you're waiting for the stock to move. Right? Like buying, especially out of the money options, right? Buying out of the money options, right? The man comes every day and you lose. Every single day the stock doesn't do what you think it was going to do, you lose, right? Because right, being long options, you're losing that time value. So the way to hedge against that is buy much longer dated options than you plan to hold them, and then if you think it's going to happen in 2 weeks, buy an option that's much longer than that. If it happens in 2 weeks, great. If not, your option still has some value that you can sell back to the market. You were wrong, but you're not 100% wrong. To me, that's a much better outcome. All right, that's all the questions that people had ahead of time. If you have more questions, put them in the box. Peter already has a question in here. He says, what happens to cryptos that get lost because of forgotten passwords? That depends, right? Like if you have a Coinbase account or whatever and you forget your password, Coinbase can help you reset your password. If you have a more standalone, let's say, cryptocurrency wallet, where it's your wallet, it's not controlled by anybody else, you have the keys. Well, if you lose the keys, that's it. You can hope you find them, but yeah, once that gets locked away, it's basically gone, right? There's no real way to retrieve it, right? It's assigned to the wallet. It's it's on the blockchain. The blockchain can't be changed without the agreement of all the miners. You have no way to prove that wallet address, which is really, right, like the Bitcoins don't belong to you so much as they belong to the wallet. So whoever has the keys to the wallet is the owner of the Bitcoin. If nobody has the keys to the wallet, well, then the Bitcoin is basically just sort of there in limbo, kind of not owned by anybody until you find those keys or somebody else finds the keys. So Uday says, can you tell us the success rate of recommendations on option trades for InvestorsObserver? So we don't actually track a lot of the trades, and the reasons for that are, if you want to look at something like the option screener, right? We'll just look at covered calls real quick. All right, we'll call that 3,400 covered calls today. Nobody's doing all of those trades. Right, probably nobody's doing one covered call every day because most investors I know don't have enough money to buy 100 new shares of stock every day. So any kind of performance we put on something like that, even if you want to look at the options dashboard where there are, say, the featured trades, 3 covered calls a day. Again, right? Nobody's buying 100 shares of stock and then selling a call against it every single day. So anything we did to track the performance of something like that wouldn't reflect any actual user's performance, right? Whereas what we actually would, what you're looking for is what can I expect from this service? And so we could give you a bunch of numbers like that, but they would be meaningless because they're not what you would expect, right? So the portfolios, you can look, view closed trades. Don't know where the closed trades went. They were here earlier. There we go. All right. There's a record of all the portfolio trades here. It goes back several years, 445 pages worth, it looks like. No, 445 trades. So you can see those there. Yeah, you can, there's good times, there's bad times, there's some winners, there's some losers. It's all in there. The Investors Keyhole service, which is 4 credit spreads every day that you get by email, we do track that. It's 89 and a fraction of the trades in that service over more than 10 years have returned to full profit. So that's better than the 8 out of 10 example you provided there. It's closer to 9 out of 10. And that held through, through this year, I guess. Yeah, December expiration was Friday. It was about that for 2021 as well. Again, though, right? Like there's 4 of those a day. It's possible you could pick some. It's possible you could hit 100%. It's possible you could do a lot worse than that. It really depends on which of the trades that you pick. All right, so Ross has an interesting question here. What do you think is the possible effect of the real estate market in China adversely affecting the Chinese economy and then the worldwide economy and our stock market? So this is like China Evergrande Group and some other real estate developers have gotten into, let's call it, trouble recently. They're having trouble servicing their debt. They got sort of over leveraged and are having some problems. Generally, I think the risk of this to the U.S. and the stocks, well, with a big asterisk, to the stock market in the U.S. are relatively slim. And the reason for that is, right, China's a communist country. Their economy is controlled by the government. It's not really in the government's interest to let a lot of really bad stuff happen to the economy. So I think they'll probably, I don't think they're necessarily going to prop up Evergrande, but I think it will be a relatively orderly wind down. If you want to put it in U.S. terms, think Bear Stearns as opposed to Lehman Brothers. Right, right? I just don't see them, letting that collapse as much as possible, and I don't see where there's a lot of contagion. Full disclosure, I'm not an Evergrande bondholder. I might be more upset about it if I was. I wouldn't necessarily expect for those bonds to pay off, the dollar-denominated ones even, to pay off 100 cents on the dollar. But I don't think there's a ton of concern about spread, and the reasons for that are, if you think about the fact that people have been, various politicians in this country have been worried for years about our trade deficit with China. What that means is we buy more things from China than they buy from us, and it is not close. So, quite frankly, right now you're in a situation where the question is, can the Chinese economy get so bad that China doesn't want to sell us stuff anymore? Well, no, right? Like, the reason an economy gets bad is people stop buying stuff. So if there's a steady buyer in the US, they're going to keep selling stuff as much as they can, right? Like, why would they stop that? That doesn't make any sense. There may be less demand for US stuff, but that is potentially a positive for, I'll say, most people in the US, right? If I'm a soybean farmer and China has trouble buying soybeans, maybe I'm not super excited about that. But if I'm a US consumer and I'm worried about my grocery bill, China buying less US agricultural goods is good for me. Otherwise, right, like just a slowdown in use of resources internally in China, right? Like, let's say China starts building apartment buildings and things like that a little bit slower. Well, that takes away some demand for steel and concrete and energy, all of which probably lets the price of those things globally sort of at least stop rising so fast. So yeah, I don't really think that's a problem. Right, I think it may in some ways, like some slowdown in growth in China could actually be good for people in the U.S. For those reasons. Now, our stock market gets interesting. There's a bunch of Chinese stocks, right? And I've talked about this before, but yeah, I think a lot of them, more and more of them look like they may be delisted or move their listing to Hong Kong or something like that. And I don't own any of those stocks. I've talked about why I don't own them in the past, which is basically, again, China's a communist country. If you know anything about communism, the idea of private property doesn't really exist, right? The government can come take it whenever they want. And so the idea that you in the United States, right, like the Chinese government, it turns out, does care about not making all the people in China really mad. Right? They really don't care about making you, a person in the United States, really mad. So if there's a bunch of stocks that are popular in China, things they can do to support the Chinese economy, I think they'll do. Things they'll do to keep U.S. investors from being mad, I really don't think they care. That may be a benefit to them from their way of thinking, for all I can tell. Will the increase in interest rates being planned by the Fed adversely affect residential construction because of higher interest rates on mortgages? All right, that's a good question. Let me go grab something here real quick. All right, so this is the interest rate on 10-year treasuries, which is, right, the Fed sets an overnight interest rate. The interest rate on, most mortgages are tied to something like the 10-year treasury because that's about the average duration of a mortgage. All right, so the Fed meeting was, hang on, let me fix my chart here. All right, so here's the last year. That Fed meeting was, I forget exactly when it was. somewhere around the 6th, maybe. So there's the 8th, right? In any case, here's the end of November. Interest rates are lower since then, which is to say the Fed raising rates overnight doesn't necessarily do much to the Treasury yield. And secondly, home builders can pretty much sell houses as fast as they can build them right now. One of my coworkers just got a house a couple weeks ago that he essentially agreed to buy in July, and it was supposed to be delivered in something like October. Yeah, right. Like the problem in home building right now is there are some supply issues in terms of cabinets and windows and some of the other things you need to finish a house that are delaying completions. And also home builders, right? 2008 seems like a long time ago to me and maybe to you. But I feel like if you're in the home building industry or something like that, and we're really, really directly affected by it, it maybe is a fresher memory in your mind, and they're have been pretty unwilling to get over leveraged, carry any amount of built but unsold home inventory. And yeah, again, they're selling every house they can build pretty much as soon as they can build it for whatever price they want to set on it. So honestly, if slightly higher interest rates cooled off the housing market a tiny bit, I think it might be good for home buyers, and I'm not sure the home builders will really notice that much. It may mean a couple basis points off a gross margin and not much else. All right, well, it is after 5. That is all the questions. So, thank you all for coming. I know it's, around the corner from Christmas. But yeah, thank you for coming. The session was recorded. We'll post the link. We'll post it on the website tomorrow and email you a link so you can watch it. Just a YouTube video. The next one will be in 3 weeks, which is somewhere around the middle of January. Let's call it the 12th. Yeah, thank you for coming. Thank you for subscribing to Investors Observer. Have a Merry Christmas to all those who celebrate. And yeah, I'll talk to you again soon.